Oh my gosh. Elon Musk is driving these traders absolutely positively crazy because, of course, it looks like he might back out of the deal. Will he really? What would that actually mean? Are there penalties involved? I've got all the details on it for you. We're going to get to it. But we also got to talk about what I would call one of the dumbest moves in energy policy ever. Joe Biden, our president, is canceling one of the most high-profile oil and gas lease opportunities that have been pending before our Interior Department, because somehow the idea is let's just keep canceling all these drilling opportunities and that'll make oil prices go lower. I don't think so. We got to talk about all of it. Plus, Pelosi saying that she's going to enforce a certain cap on pricing. Hello, everyone. Welcome to the Trish Regan Show. I am Trish. Good to have you here as always. Happy Friday, by the way. I hope you're going into a really wonderful weekend. A reminder that portions of today's program are brought to you by LegacyPMInvestments.com. Legacy Precious Metals. There has never been a better time to invest in gold than right now. So go to LegacyPMInvestments.com for more. All right, I want to talk about this Twitter thing. Elon Musk giving everybody invested in this stock a bit of a heart attack in Friday's session. Well, before trading started on Friday, you see, he tweeted that it would be on hold because because there were too many fake accounts, right? So that didn't go over so well. In fact, it went over so poorly that the stock just plummeted at last check, down about 8% in trading. You know, it had already been down, don't forget, just in Thursday's session. So it continued trading down amid fears that Elon is seriously looking to get out of the deal. Is he? He tweeted out a couple hours later, perhaps realizing, I think the stock was down like 25% in pre-market trading, realizing that this would be really disconcerting to investors, that no, it wasn't over. But it is possible, I'm just going to say this, it is possible he's getting some cold feet. And the reason he might be getting cold feet is because, well, he didn't do his due diligence in the interest of just getting the deal done initially. Normally there's a due diligence process. He didn't do that. And so now it's coming out that, well, a lot of the accounts could be fake on Twitter. And this was per, I think, a Reuters report. So understandably, naturally, he's a little worried. He might be concerned about his investors that are putting money in as well. And so he tweeted this out. And, suffice it to say that people are either rejoicing or, if they are invested in the stock, really pretty nervous. I want to point out, though, that in any of these deals, you do have breakup fees. And so it would be quite costly for him. I mean, I think he'd have to pay somewhere around $1 billion or so if he tried to get out of this deal. It could happen, but again, it would be, $1 billion that you're just sort of throwing away. Incidentally, shares of Tesla, they were way up on the news in Friday's session because Tesla investors are like, great, now we don't have to worry about our stock being correlated to the fate of Twitter. Anyway, the saga lives on, the drama goes on, and we will know more next week. Let me turn to this insane drilling stuff because it's like you can't make it up. The Wall Street Journal did a great thing the other day. I actually said this months ago. It's like Joe Biden needs to channel George Costanza from Seinfeld, where you just do the opposite of what you think you should do. That might actually help. I mean, Wall Street Journal had a great op-ed saying the same exact thing just the other day. And this is one where, we really need, where's George? Where's George Costanza? So the Biden administration is canceling drilling leases despite the fact that we have record high oil prices. This is a decision that I think is going to have some pretty serious consequences. So they are halting this drilling in the Cook Inlet in Alaska. This is a pretty significant high-profile oil and natural gas lease opportunity that was before the Interior Department. And it's a little strange because he's been saying, in recent months, we're going to boost our oil and nat gas production here in the U.S., right? Has the situation overseas not taught us anything in terms of the importance of being energy independent? And yet now with inflation at a 40-year high, with energy coming off of the market, so therefore driving energy prices even higher. His idea is to not approve leases. I mean, it's sort of mind-boggling, and yes, brings us right back to that Seinfeld George Costanza example. Please start doing the opposite of what you think is right. Turning to another person who needs to channel George Costanza, that would be Nancy Pelosi, Speaker of the House, saying in her weekly address that she intends to introduce legislation that would allow Biden to set gas prices. Are we going back to the 70s? I mean, Jimmy Carter, where are you? We're going to ration gas? We're going to set prices? That's your answer to this energy crisis? It's worth just taking a little teeny moment and having a little Econ 101 session with all of these lawmakers, because they don't seem to understand that supply and demand are correlated, and that pricing and incentives are also correlated. So if prices are capped, do you think anybody wants to be in this industry? Do you think businesses are going to want to drill more knowing that they can't make more, depending on whatever the price should be in the open market for oil? No, of course they don't. And so it means you're not going to have enough supply, which is going to keep prices consistently high, right? OPEC knows this. OPEC chooses not to pump more oil because it wants to keep prices high. So we're going to say, okay, we're going to cap prices, which is actually going to disincentivize corporations from wanting to be in this business. And we think that's going to be the answer. Unbelievable. I mean, these people really don't get it. The stupidity level is off the charts and kind of depressing, because we're a pretty important country and nation, and they are educated individuals, and they ought to be able to understand this a little bit better. But it's all politics. They think this sounds good. It doesn't sound good. And not only does it not sound good, it's going to result in gas lines just like the Carter years, okay? We've been there, done that, seen that. Not again. But it does bring me to gold. It brings me to gold because one of the most important things you can do for yourself right now is hedge out this inflation. And we're getting more and more inflation. 8.3% you saw on consumer prices this week. Then we got 11% on wholesale prices. In other words, we got tons of inflation out there. And with all this inflation, your dollars are not going to go as far. You're not going to be able to buy as much. And over time, this really matters. It's one of the reasons why I really like gold in my portfolio. A small part of your portfolio. I'm not talking the whole thing, but you can shoot for anywhere from 1% to 5% of your assets in gold. It's just a helpful thing to have. And you can get a gold-backed IRA, which I recommend. And I really recommend you call my friends over at Legacy Precious Metals, legacypminvestments.com. These are great guys, family-run company, been in business many decades, and they know the gold industry inside and out. So they can help you navigate this. They can help you get a gold-backed IRA. They can help you get the real stuff. If you want it in your basement, you may have heard me say you can put $1 million worth of gold in a shoebox. Who knew, right? Okay. Turning to the markets, we have seen so much volatility over the last week, well, frankly, since the start of the year, and most of it's been down. We'll see whether or not this turns into be a little bit of a relief rally as we head into next week. But, a lot of investors are saying, maybe I don't have the stomach for this. If you're one of those people, I get it. My next guest totally gets it, and he's got some terrific ideas for you to invest in. I'm calling this anything but stocks, right? I'm so glad to have back on the program here with me today, Charlie Dombeck from Key City Capital. Charlie, good to see you.
Good to see you as well, and great to be here, Trish.
So you have predicted a lot of this volatility. We'll get into whether or not it's going to stay for the foreseeable future, but I really want to start with this. If you're somebody who's like, I don't want to risk what I could be risking in the equities markets right now by investing in stocks, are there other things you should be doing, or at least diversifying into? I know that Key City Capital does a lot within real estate, but this is your field of expertise, and I guess it's a big world out there. Tell us a little bit more about it.
Yeah, look, Trish, I've been a practicing CPA for 30 years, and I've counted a lot of people's wealth over a career of work. I have seen major successes, major failures, and I've come across a strategy and a process that I really believe helps clients improve investment performance and grow their wealth rapidly. It's disruptive. It's not working with your financial advisor. It's not parking all of your capital in one asset class, which is essentially financials. The recipe I believe that really works in today's economic environment is having assets and wealth in three buckets of investments. One is financials, one is passive investment real estate, and the other is alternatives. The basic problem is that we all, or many of us, have the bulk of our capital invested in the financial
Right.
markets.
And by the way, when you say financials, it's not, bank stocks, it's the financial, markets, meaning bonds and equities
Stocks,
and all that
bonds,
stuff. Yeah.
mutual funds, ETFs, it's products that are available from your traditional financial advisor.
And
And
there's a reason for that, right?
there's a reason for that is because investment advisors have limited choice. They earn their income from assets under management, AUM, as it's called in the industry. They earn fees from having more capital under management. And so advisors don't want you to move capital into either passive investment real estate or alternatives in what we call private placements because they cannot earn asset management fees or commissions from those investment placements.
Well, some of those placements, what's interesting is they've typically only been available to kind of the uber rich, right? Like if you get a family office and you're out there talking to private equity shops, you might be invested in some of these things. But for everyday folks, they just don't even have access necessarily to this. Am I right?
They have not had access to these investments over a career of work. And what you find is the mass affluent, people that are, say, worth between $2 and $20 million, largely get underserved by their team of financial professionals. Their financial advisors have limited choice, and the investment opportunities that the ultra wealthy have access to have not traditionally been available to this category of investor. What I have found is that when we are able to bring those investment opportunities that are typically available only to the ultra wealthy to this class of investor, then we get substantial improvement in investment performance, lower risk, better diversification, and a pathway to reach your financial independence goals much earlier than in life than normal retirement age.
I mean, look, I think it's great. What you're doing, and I'm getting all this right, is you're kind of opening up the market, right? Exposing people to investment opportunities that they wouldn't have normally seen. And there's reasons for that, as you articulated, and it's not really entrenched in the industry, right? Your investment advisor isn't going to do well by putting you into private placements, and so that's where you guys come in. That's what Key City Capital does. I mean, what are some of the most interesting plays in this alternative space for you right now?
Well, asset-backed lending, for example, where your investment performance is tied to interest rates, where in a rising interest rate inflationary environment, those types of investments perform very well. And we do have an asset-backed lending portfolio at Key City Capital where we invest in a couple of very niche markets where there's not a traditional capital source. For example, we finance the acquisition of ultra high-end vehicles that have been lightly to moderately damaged and turned back into the large loss departments at a handful of very big insurance carriers. We have access to those vehicles before they get auctioned off.
I got to stop you there because that's kind of neat. What do you mean? Like,
Yeah,
you take a
so
Maserati or a Ferrari that's been banged up and you turn it
exactly.
around?
Yeah, these are vehicles that are not salvage titles, but what bank is going to lend a collision center $100,000 on a Ferrari when it's damaged? No one's going to do that. So we provide the capital and earn a very high rate of return for use of capital for a short period of time. And the great news is we have a hard asset that represents a store of value that is securitized for that capital placement. And last year, that investment portfolio did 167% rate of return.
Oh my gosh.
Yeah.
That's amazing. That's really, I mean, and you never think about these things. You really don't.
You don't. And you don't have access to these opportunities until you've had the exposure that I have had over a career of work in the financial industry. Look, I couldn't have found these opportunities in my 20s or 30s, but having worked as a CPA, you come across opportunities like this, and I've been able to make those available through Key City Capital to the type of investor, those people with a net worth between $3 and $20 million that can get great performance out of something that would normally not be available to them. And we constantly search for these niche opportunities where we can deploy capital responsibly and earn a high rate of return for use of capital for a short period of time. And that's just one example.
Yeah, no, I mean, and we've talked about the real estate before. I think it's worth sort of mentioning again because this is perhaps the most intuitive to people that are looking to be in real estate. Look, real estate's been on fire, right? I mean, which I guess is good in terms of the value appreciation in your portfolio. But how are you thinking about real estate investing these days?
The multifamily residential real estate category is the number one asset class right now as a hedge against inflation and performs exceptionally well in a rising interest rate environment. And if you think about what's happened in these Sun Belt states, we've seen massive increases in rents across the board in all of these Sun Belt states. That trend is going to continue. There's going to continue to be additional cash flow and yields in multifamily space. And I recommend that all clients have exposure to this asset class, not through a traditional financial product like a REIT, but through a private placement where you have the benefits of direct ownership of a real estate portfolio. And that's what we do here at Key City Capital.
What's the difference? I mean, walk us through sort of the REIT, which you can
difference
trade.
is a REIT gives you access to the cash flow from a residential rental portfolio. As a owner of a private placement, you are considered a fractional owner of every asset in the portfolio. You get a share of profits from the rental income, you get a fixed rate of return, and you get the benefit of a large capital event when those assets are sold. And during the life of the investment, you're getting a depreciation deduction that in many cases fully offsets the earnings that you're receiving during the life of the investment.
It's a lot to take in, but
right.
you know,
So
I tell people you can go back and watch it again,
so
or you can call Charlie.
Right, you can call. Very simply, you are an owner of real estate without all of the headaches. So you don't have someone calling you for a maintenance issue. You're not having to worry about collecting your rents. You have a team that's all they do. And they create a significant, massive rate of return for their clients because of the focus in the Sun Belt states and on workforce housing.
What's your sense of where we're heading? I mean, we got 8.3% inflation on consumer prices. We're down. Hey, 0.2%. I'll take it. But I don't think it's going to continue going down, or even if it does, we still risk, I suspect, Charlie, being in this rather high stratosphere for a while. We just got the producer price index out this week showing 11% inflation on wholesale prices. So if this inflation keeps going, I mean, it's going to get harder, wouldn't you think, to be invested in
so
stocks?
Inflation is continuing to rage at an unprecedented level that we haven't seen in the likes of 40 years. And yes, we had a slight dip from the prior month, but largely because gas prices dropped, and now gas prices are at an all-time high. So do we see a decline over the next 7 to 8 months? Maybe by the end of the year, we're at 4 to 5%. But we're well above the Federal Reserve's target rate of 2%. So we're going to continue to have at least a 0.5 point interest rate increases in each Fed cycle. The markets are going to continue to react like they did in the last week and a half to 2 weeks. Major sell-off, major downward pressure, sprinkled in with a potential relief recovery here and there, but not sustainable. And this is not the time to buy the dip. This is the time to responsibly reallocate your capital, preserve the gains that we have experienced over the last 3 to 5 years, and get money in these other two asset classes. That is a recipe for success. That is what's going to work in the next economic cycle. That is what will accelerate the way clients grow their wealth and ultimately get to a point where they have more freedom of choice and the opportunity to have a better flexible lifestyle and more financial freedom.
No, it's what everybody wants, and that financial freedom. I mean, that's what I think everybody's chasing. And look, what you're saying is important. I can't stress enough how critical it is to be diversified. And so I'm not saying you don't want to be in the stock market. You do, of course, but there are other things out there. And I think what you're talking about is really opening up a whole new world for everyday folks that normally they wouldn't see. And it's exciting, and it's a democratization, if you would, I think, of some of what we see in the financial industry. So it's good stuff. I encourage people to give you a call, Key City Capital, Charlie Dombeck. And I know you're a CPA and you work with people, right, to kind of figure out where they can get these savings so that they can be more creative with their investments.
Absolutely. Two things make the big difference in terms of how fast and how much wealth you accumulate, and that is how much you pay in state and federal income taxes and how well your investments perform. And I have been a trained tax planner my entire life, and I help clients recover dollars they unnecessarily pay in the form of state and federal income taxes. And of course, we've talked in depth about the investment work that we do. Those two things make the big difference. And we work one-on-one with individuals in that demographic audience that are largely underserved by their team of financial professionals.
It's great stuff. It really is. Charlie Dombeck, I so appreciate you coming on. Thank you so much for your time today.
Thank you.
So interesting talking to Charlie. I always enjoy our discussions together because you know what? There is this whole big wide world out there. Lots of things, right? Besides just stocks. And it's important to think about that. It really is. Right now, diversification is so critical. I think the last few months have certainly shown us that. But I just love the idea of being able to think outside the box and not just buy the S&P, right? There's a whole lot more to this world, and Charlie always does a great job at showing us that. Thank you, everyone, for tuning in. I hope you have a wonderful weekend. I hope you get a little time with your family, a little bit of sunshine. I know I will, and I look forward to seeing you here, as always, on Monday.